Markets don't just move on data. They move on emotion. How does psychology influence financial markets? People often think markets are logical, driven by numbers, earnings, and economic data. But markets are built from human decisions. And humans are not perfectly rational. Fear, greed, panic, and optimism constantly shape buying and selling behavior. That's why markets often move in ways that seem irrational on the surface. 10 ways psychology drives financial markets. 1. Fear causes panic selling. When prices fall, investors fear further losses. Instead of evaluating value calmly, they rush to sell to avoid more pain. This accelerates declines beyond what fundamentals justify. 2. Greed drives overbuying. When markets rise, people chase profits. They buy not because assets are undervalued, but because prices are increasing. This pushes markets higher than their real value, creating bubbles. 3. Herd behavior amplifies trends. Investors often follow the crowd instead of independent analysis. If everyone is buying, more people join. If everyone is selling, panic spreads. This collective behavior magnifies market movements. 4. Loss aversion distorts decisions. People feel losses more strongly than gains. This leads to holding losing investments too long and selling winners too early, creating inefficiencies in markets. 5. Overconfidence leads to excess risk. During strong markets, investors believe they are more skilled than they actually are. This leads to higher risk-taking, leverage, and eventual sharp corrections. 6. Recency bias shapes expectations. People assume recent trends will continue. If markets have been rising, they expect continued growth. If markets have been falling, they expect further decline. This bias fuels both bubbles and crashes. 7. Narratives influence valuation. Stories about innovation, disruption, or future growth can drive markets beyond current fundamentals. Strong narratives attract capital even when financial performance is weak. A. Fear of missing out, FOMO. Investors enter markets late during rallies because they don't want to miss gains. This pushes prices even higher, often near the peak of cycles. 9. Panic creates liquidity crises. During extreme fear, investors sell assets quickly to raise cash. This creates sudden drops in prices, even for fundamentally strong assets. 10. Confidence drives stability. Markets function smoothly when participants trust the system. When confidence breaks, volatility increases and price movements become extreme. Final truth. Markets are not purely logical systems. They are emotional systems operating on financial structures. Understanding psychology is not optional. It is essential to understanding how markets really move.